The gold and silver markets, gold and silver charts actually still look very, very strong. We'd have to get, low 3,000s to even start thinking about this market breaking down. If it does go below 37.50, I don't think it'll last very long. This is the kind of the buying opportunity. Silver's the same way. We actually had a 54 handle last week. I don't think now we're at 58. So anything in the 55 to 50 area is kind of a bottom, I think. So we're kind of in a buy zone. So you're smart to buy. You want to buy here. You want to buy bottoms. Silver made an outsized run last time to 120. And it's not crazy to think that we could get to 5,600 in Q4 this year, and it could go a little lower. The technicals seem to support around 37.50, and I think those technicals will hold. We'll have to wait and see, but you could get an overshoot. You could go down to 3,500, which a lot of people are thinking. When you have this really low ratio right now, when the S&P is outperforming gold, when it's like 0.5, and it was at 6, that's a 12x difference. And it shows sentiment is in the toilet for the miners.
Don, since the start of the war in Iran, gold has pulled back from near 5,600 to around 4,000, and silver from about 120 to below 60. Are the precious metals in a new normal now? How do you view these pullbacks?
We've had two bull markets, 1972 to 1980, and then 2002, actually 1971 to 1980, and then 2002 to 2011. So both basically 9-year bull markets. Both of those bull markets, we had significant corrections. We had quite a few of them. So as a matter of fact, it wasn't unusual to have a 10% or more correction every single year in those bull markets. And we actually had a 50% correction in gold in the 1970s. I don't think we're going to get that. I'm not sure how deep the deepest one was from 2002 to 2011, but it was definitely significant. So it's not unusual to have deep corrections. But the key here is have these markets broken? Are they broken? Has the bull market, are the charts looking like they've broken down? And the answer is absolutely not. The gold and silver markets, gold and silver charts actually still look very, very strong. As a matter of fact, if you use the 200-week moving average, you'd have to go all the way down to, I think, 2,800.
Markets celebrate every pullback, yet history shows corrections often strengthen the biggest bull markets. Don Durrett notes previous gold cycles repeatedly endured double-digit declines without ending the broader advance. Wall Street headlines focus on falling prices while ignoring long-term trend structures institutions quietly monitor. Investors who mistake volatility for failure often surrender positions near major support. Next, Don Durrett reveals why today's correction resembles accumulation, not collapse.
So I think, the lowest we got, I think was 30, I want to say 3,900. I don't know if we got to 3,800 handle. So we'd have to get low 3,000s to even start thinking about this market breaking down. Silver, it broke out last year, 1 year ago, at the 35 level. So it's actually up 50% year on year. So how can you call a breakdown when you're up 50% year on year? That's a pretty big move. So silver would have to go back down, mid 40s, low 40s to break down. And stay there. And I don't think that's going to happen. So as far as breaking down, I don't think we're seeing that at all. So this is, I think, just a correction. And when the one thing about these miners is you need to be smart when you buy and smart when you sell. And you don't want to be, you always want to buy bottoms and you want to sell tops. And you don't want to see. And so, what is a bottom? So a bottom is like what we're currently having right now. So we're down about $4,000 gold, and you have to look at how much lower can it go before this thing turns around. I think 37.50 is far. I think that's probably a good target for the bottom here. I don't think it'll go much lower than that.
Temporary price declines become permanent losses only when investors panic into selling quality assets. According to Don Durrett, silver remains dramatically above last year's breakout despite today's unsettling correction. That's the distinction mainstream coverage rarely makes, because percentage pullbacks attract clicks while long-term performance tells the real story. Patient capital typically benefits when emotional capital exits first. Next, Don Durrett exposes why identifying bottoms matters more than predicting headlines.
If it does go below 37.50, I don't think it'll last very long. So I think this is the kind of the buying opportunity. Silver's the same way. We actually had a 54 handle last week. I don't think now we're at 58. So anything in the 55 to 50 area is kind of a bottom, I think. So we're kind of in a buy zone. So you're smart to buy. You want to buy here. You want to buy bottoms, and you want to sell tops. You don't want to buy to the top. So, for instance, anybody who was buying, say, from December, January, February, turns out that wasn't a good time to be buying, because you were chasing a market. And instead of, you want to be patient. When markets break out, you go to the sidelines and you wait for the next correction. So we're in a correction here. I think we'll get one more buying opportunity. So we've had these nice buying opportunities in June. I think we had a couple of them. June was when we went down to the 200-day moving average to 4,100, and silver went down below its 200-day moving average as well. So when you're down the 200-day moving average, those are actually good buying opportunities. I don't think we're going to get very many more buying opportunities, because I think the second leg is coming. And that second leg, I think it'll begin in Q4. And when that second leg goes up, I think we're going to get a new all-time high in gold and silver both, especially gold.
The biggest investing mistake is usually buying after excitement replaces patience. What Don Durrett is highlighting is that successful investors wait for corrections instead of chasing momentum after headlines turn bullish. Markets repeatedly reward disciplined entries near technical support, while emotional buying often clusters near temporary peaks. That difference quietly separates institutional accumulation from retail speculation. Next, Don Durrett reveals why seasonality could become the hidden catalyst behind the next major advance.
Now, silver made an outsized run last time to 120. That one's going to take some time to get to. But the 5,600 on gold, I think I definitely think I expect to see that in Q1 of next year. And it's not crazy to think that we could get to 5,600 in Q4 of this year.
All right. So what's the significance of the 3750 that you mentioned for the bottom? And as far as Q4 for the run up, why are you targeting Q4? Does it have to do with seasonality?
Yeah, absolutely. So seasonality for gold is always the second half of the year. You can get a little bit of a run in January, but gold historically does well in the second half of the year. You get to September and you have the Indian wedding season, which has always been good for gold. And then Q4, it seems like you always get a bit of a end of year rally. You get it in both stocks and gold, both. Last year, I mean, if you look at what gold did from November to January last year, it just went straight up. So it loved that seasonality. And so you have negative seasonality in the stock market from mid-September to mid-October, which we're entering now. And so that's going to put a headwind on gold. And so you're probably going to see the S&P, I think, correct between now and November. So if the S&P is going to correct, that means more than 10%. I think gold and silver will get pulled down to that 3750 level.
Wall Street treats seasonality like folklore until institutional money starts positioning around it. Don Durrett's argument suggests recurring calendar patterns deserve attention because professional traders have respected them for decades, even while public narratives dismiss them. If equities weaken during their seasonal soft patch, precious metals could face temporary pressure before capital rotates back towards safety. Investors should prepare for volatility instead of fearing it. Next, Don Durrett exposes why technical support and market psychology rarely separate during major turning points.
Which it could go a little lower. The technicals seem to support around 3750, and I think those technicals will hold. we'll have to wait and see. But you could get an overshoot. You could go down to 3,500, which a lot of people are thinking, a lot of people are expecting. That's the next level of support below the 3,750 level. So the technicals are both there. Right now, I think you need to be aggressively buying, but also anticipating buying lower. So I've been aggressively buying since we went down to that 4,100 level, and I'm expecting to be a buyer here, depending on what gold does over the next 4 to 8 weeks.
All right, so you mentioned that S&P 500. The gold to S&P 500 ratio is when you take that gold price, you divide it by the S&P. In 1980, at the peak of the cycle, that number was around 6, and today it's near 0.55. Why is this correlation important, and what are you looking for here?
That's actually my favorite chart as an investor. As far as I'm concerned, it's the most important chart for gold and silver mining investors, because that will show you two things. It will show you sentiment. So when you have this really low ratio right now, when the S&P is outperforming gold, when it's like 0.5 and it was at 6, that's a 12x difference. That was in 1980.
Markets rarely bottom when everyone agrees on the exact support level they're watching. This is where Don Durrett's thesis shifts from price prediction toward investor positioning, because scaling into weakness reduces dependence on perfect timing. The overlooked gold to S&P ratio also exposes where institutional enthusiasm still overwhelmingly favors conventional assets instead of miners. Sentiment usually changes long before headlines admit it. Next, Don Durrett reveals why one overlooked ratio exposes Wall Street's biggest blind spot.
We went to about 3.5 in 2011. So 0.5 is really, really bad. So that means, and it shows, sentiment is in the toilet for the miners, because the stock market is doing better than gold. And Wall Street doesn't want to buy gold miners. They don't want to. They only buy it when they have to. And so the stock market's been doing fine for 15 years. So they're basically been on this train for a long, long time, and they're not ready to get off of it. We're at 7,500 S&P right now. So if you divide 4,000 into 7,500, it's not a real pretty picture. And so 0.55. And so we need to get to about 0.7 before things start to turn our way. And then, again, I said, this is really the only chart that really matters. So it tells you two things. It tells you sentiment, because when the number is down, it just means nobody wants to own the miners. Everybody wants to own the S&P. And the other thing that it shows you is the trend. And right now the trend is up, even though it's ugly. But if you go back and you look at that chart, it actually based below this level. So we actually are trending up, but it doesn't look like it, but we are. In other words, we have turned it around a little bit. That was that last year run when gold went up $2,000, in 2 years. It went up $2,500 in 2 years. The
strongest bull markets often begin when almost nobody wants exposure to them. Don Durrett notes that depressed sentiment toward mining stocks reflects years of capital flowing into equities rather than hard assets, creating a powerful asymmetry if that trend reverses. History shows institutional money rarely waits for public confidence before reallocating. That's exactly why sentiment indicators deserve more attention than headlines. Next, Don Durrett unravels how capital rotation quietly begins before most investors even recognize it.
It had a bit of an impact on that chart, but we're still at 0.55. So the other thing that it shows is capital rotation. It shows capital rotation out of stocks and into gold. And so as that chart improves, you start getting momentum and you start getting better sentiment. And so that's why I say this is the most important chart if you own gold and silver miners, because we want the sentiment to get better. We want to get the momentum better. We want that chart to start looking up. So again, it was at 6 in 1986. So that's 12x difference from here. But I'm not expecting nowhere close to 6. What I do think is going to come is we're going to get two, and two would be amazing. So two would be something like $8,000 gold and 4,000 S&P. Gold is 2 times the S&P, not 6 times. We're not going to get 6 times, but we could get 2. We should get 2. And once we get to 1, in my opinion, 1 is the most important number here. So what is 1 to 1? So it's a 1-to-1 ratio. And that's what we're waiting for as investors, because if we get to a 1-to-1, that means there's been rotation into gold and into the miners, and we got the wind at our back. And now we're starting to win. We're starting to win. And I actually think that we win at 1, and it'll just go from 1 to 2. So what is 1? Where will we have a ratio of 1 to 1?
Every cycle has a moment when capital quietly abandons yesterday's winners before retail notices. According to Don Durrett, the gold-to-S&P ratio captures that transition better than daily price movements ever could, once institutional allocations begin shifting. Momentum often feeds on itself, while late investors are still debating whether the trend is real. Protecting wealth frequently means recognizing rotations before they're obvious. Next, Don Durrett exposes the milestone ratio that could redefine this entire bull market.
I think it'll be somewhere between 5,500 gold and 6,000 gold, which is kind of a long, it's not going to happen overnight, but we're only at 0.55.
What's your timeline for that?
Q4 next year, Q1 of next year, Q1 of next year, maybe into Q4 this year is a possibility if gold really rips here in November, December. But it's probably going to be Q1. And then, so once you get the S&P below 6,000, that ratio is going to be pretty tight, right? So you get the S&P below 6 and you get gold at 5, that's about a 0.9. So you're getting, that ratio is really tightening. So that's what we're looking for. I want to get to 0.7. 0.7 is really when it starts to go our way. But once you get to 0.8, you're starting to really look good. And so you don't want to get in these miners. You want to get them now. You don't want to get in when you're at 0.8, 0.91. You're late to the story. But again, it was 6 in 1980, and it was about 3.5 in 2011. So I don't think we're going to 3, but we're definitely, I think, going to 2, and we could come close to 3. So let's use 3. The reason why I don't think we're going to go to 3 is because there's going to be so much money printing that the stock market, I don't think the stock market is going to crash and burn.
By the time financial television celebrates a new trend, most of the easy gains are already behind it. What Don Durrett is highlighting is that ratio milestones matter, because they signal changing capital flows before public enthusiasm catches up. Waiting for perfect confirmation often means accepting substantially higher prices and lower future returns. Institutions rarely advertise when accumulation begins. Next, Don Durrett reveals why money printing may prevent stocks from collapsing even as gold keeps outperforming.
So, in order to get 3, you'd have to have like 9,000 gold and 3,000 S&P. That's a lot. That doesn't look like it's going to happen, right? So at 3 is going to be really hard to achieve, but I think 2.5 is definitely in play here. 2.5.
So Don, what's the catalyst, in your opinion, that stalls the S&P, even drops it, as you were saying, down to that 6, 5 range, to get that first 1-to-1 number? What's the catalyst that's going to pop that S&P?
Well, that's a really big question that, I could spend 30 minutes answering, because the catalyst is going to be all the macro factors. And there's a lot of them, right? And so the macro factors is what is holding the economy up. Now, again, I firmly believe the reason why gold went up $2,000 is for only one reason: the U.S. bond market. The U.S. bond market has gotten out of control. And all you have to do is look at the debt. When I say the U.S. bond market, I'm really talking about the national debt, right? Because all that national debt does is go higher and higher and higher. well, that bond market becomes weaker and weaker and weaker. We've already reached a point of no return where we can't pay it back. We talk about inflating it away, right? It's up to $40 trillion and we're adding $2 trillion a year and we're paying $1.3 trillion in interest.
The real crisis isn't today's debt level, but the shrinking room policymakers have to escape it. Don Durrett's argument suggests the bond market, not inflation headlines, has become the system's true pressure point as interest costs accelerate relentlessly. Governments can postpone consequences through liquidity, yet they cannot erase mathematical reality forever. Savers ultimately absorb the cost through declining purchasing power. Next, Don Durrett exposes why the bond market may matter far more than the Federal Reserve's public messaging.
So the reason why gold has been trending up, up from 2,024 to 5,626 in 2 years. The reason why is the bond market. And I got into gold and silver miners for only one reason: the bond market. The bond market is basically, it's an untenable situation when you look at politics. So politics, they don't care about economics. They pretend, and all you have to do is watch what they do. But they pretend that the economy is basically on autopilot. That, all we have to do is, nothing, literally, basically just printing money. The economy will do everything on its own. There's nothing to worry about. That's basically considered a free market economy when you really let it go like that. But the Fed has realized that, no, we don't want a free market economy, because we have a free market economy, then you get booms and busts. You get recessions every 2 or 3 years. We don't want that because we have this big debt, right? So we have to defend the bond market. So in 2008, we adopted a new policy called modern monetary theory, where we basically said debt doesn't matter. It doesn't matter. The only thing that matters is liquidity. So this goes back to Bernanke, in his thesis on the Depression. And according to Bernanke, we should have never had a depression. All we needed to do was print money. And then Janet Yellen said, we will never have a recession again in my lifetime, because of this new adoption, the new adoption of monetary theory, that the only thing you need to do is increase the money supply. Just keep increasing it. And basically you create and then in tandem with the money supply, they manipulate interest rates below the market rate.
The Federal Reserve promises stability while relying on ever-expanding liquidity to preserve a debt-dependent financial system. This is where Don Durrett's thesis shifts toward the uncomfortable contradiction between free market rhetoric and constant policy intervention. Every new rescue may postpone immediate pain, but steadily weakens the purchasing power long-term savers depend upon. Institutions hedge accordingly, while most households remain fully exposed.